I am making a financial simulation game. The game challenges the player to spend the same amount of money over every year of their lifetime. We covered the setup for this in previous videos. In this video, we are answering the question of how large of a bet should the player make. What I mean by that is how much money should the player allocate to risky investments versus safe ones. Some people say that green is the color of money. Let's zoom in on the green color chart towards the bottom. There are two particular shades of green that are interesting. One is called Kelly and the other one is called Merton. Let's dive in to see what they have to say about betting. Here's the setup. What if someone gave you a series of bets where you had a 60% chance to double your money, but 40% chance to lose your money? How much would you bet each time in the series? Or what if someone said you had a 5% chance to make 100 times your bet, but a 95% chance to lose it? How would you play? How much would you bet? Or the third scenario is, what if there was a stock or mutual fund that had average returns of 2%, but a standard deviation of 20%? How much of your savings would you invest in that stock or mutual fund? I will try to answer these questions, but before we go further, I want to make a disclaimer that this is not financial advice. This is just a discussion about a game that I am making, and I accept no liability for any decisions you make. So it turns out that these betting problems have been solved. The first solution is called Kelly betting. The Kelly bet maximizes the geometric growth rate, and so the Kelly Criterion leads to better results than any other strategy for a large number of bets. J. L. Kelly Jr. described the criterion at Bell Labs in 1956. The Kelly formula can be thought of as time diversification as opposed to asset diversification, since you're betting only a small amount each time. The formula goes like this. F is the fraction of savings that you should wager. P is the probability that you win the bet. Q is the probability that you lose the bet. And B is the proportion of the bet gained with a win, which is like the odds. The graph on the right shows the result of the growth rate for different wagered amounts in this theoretical scenario. The scenario is a bet where you are 60% likely, so P equals 0.6, to double your money, but 40%, Q equals 0.4, to lose your money. The best bet is when you wager 20% of your savings on each bet, and that will give you a growth rate of 2%, which is the peak of the curve. The curve also shows that if you bet more than about 40% of your savings each time, you are all but guaranteed to lose all your money. So for bet A, the answer is that you should bet 20% of your money for each round of betting. Going back to bet B, where you had a 5% chance to win 100 times your money, it's easy to see that if you bet any large amount of your money, you have a 95% chance to lose it. Even if you bet 20% of your money, you still have a pretty good chance to lose all your money. So this seems like a terrible bet. Would you take it? I think the expected value of this bet is still very favorable. A 5% chance at a 100-fold increase should still be a 5-fold win for you. You should definitely take the bet, but how much should you wager? You do not want to lose your money, so you have some risk aversion. A loss is more painful than a gain to most people. This is known as risk aversion. Losing 10% but gaining 10% after is worse than gaining 10% and then losing it. This is called volatility drag. People also consider relative wealth. An extra $100 is more valuable if you're poor than if you're rich. To account for these facts, economists typically use a utility function, which is weighted to penalize losses more than rewarding gains. A typical function is called constant relative risk, which assumes a person will take the same risk regardless of their situation. It also happens to make the math easier. What if you do not know the chance of winning or losing, like in bet C, which gives a standard deviation? The answer to this is called the solution to the Merton Portfolio problem. If we take into account a utility function representing the risk tolerance like we just talked about, then Robert C. Merton solved this portfolio problem in 1969. He considered how an investor chooses to allocate their wealth between stocks, which are risky, and a risk-free asset like a savings account. Merton took into account the risk tolerance so that he could maximize the expected utility function. The way this formula works is that pi is the fraction of wealth to invest in a stock portfolio. The formula takes into account R, which is the risk-free rate of return, and mu and sigma are the expected return and volatility of the stock market, and gamma is a constant which expresses the risk aversion. The higher the gamma, the more reluctance to own stocks. Let's take some examples. The stock market typically has a volatility of about 18%. And people argue about the expected return, but let us assume a 6% return above the risk-free return. Then, using a risk aversion of 3, we get a Merton share of 62%, which is pretty close to the standard 60-40 stock and bond recommendation given by many advisors. To use the Merton formula to solve bet C, which was a 2% return and a 20% volatility, then the answer would be to invest 25% of your savings into this asset. So let's look at the spending game. In order to maximize spending, we would need to maximize the investment return while taking into account risk. How can we use the equity game to not only optimize lifetime spending, but also optimize utility? The equity allocation slider controls how much the player puts into the stock market, with the remainder put into a safe asset. The equity premium slider sets how much the stock market is expected to perform compared to a safe risk-free asset over the long run. So let's consider a fat cat, a 65-year-old person with 2.5 million investable wealth who just retired. How much can they spend each year so that their spending will be the same? And what is their optimal asset allocation so that they can maximize that spending amount? Let's crank up the simulation to about 1,500 runs and press the simulate button. The top middle graph shows that this person is retired, and the actuary tables show their life expectancy spreads out quite a bit. The top right graph also shows that they need to reduce their spending quite a lot. The median outcome they can spend is about $120,000 per year, up to age about 92. The bottom right graph shows their net worth going in not quite a straight line towards zero. For lucky market outcomes, they can spend a little more, and for unlucky market outcomes, they will need to spend a little less. In the bottom left corner, the simulation adds a data point for the 50% allocation case which we just ran. This shows the expected average utility of that decision for all the scenarios. If we change the equity allocation to 0, the simulation will add a second data point showing the utility is a bit lower. Also note that the other graphs become straight lines since there's no market variability in the safe asset. If we slowly bump up the equity allocation 10% at a time, we can add more data points to the utility graph. Eventually, we will reach a graph which peaks around a share of 0.5, which makes sense since the theoretical Merton share should be 0.56 for this person. What is a little bit scary is how much the utility function drops off for a larger equity allocation value. You can also see how much more the fortunes of the theoretical people spread out for larger equity allocations. To check the robustness of the model, we can rerun some cases. Going back to the 50% equity allocation, the difference between possible outcomes is moderate. An important lesson is that most of the utility benefit can be achieved with an allocation quite a bit smaller than the Merton share. Finally, let's go back to bet B, where you have a 5% chance to win 100 times your money. How much should you bet in each round of that game, and why do you think it's optimal? Please let me know in the comments.